Plan paid. 24,700 on your responsibility. $6,000. Two numbers that should not exist on the same page. Your insurance card is still in your wallet. This is an employer-sponsored individual plan. The hospital was in network. The service was covered. The premium has come out of every paycheck all year. The first number looks like proof that the system worked. The second looks like a mistake. You call the number on the back of the card, expecting a wrong code or a misdirected claim. Instead, you get 3 confirmations. The hospital was in network, the service was covered, the claim was processed correctly. The problem, the representative says, is your remaining deductible and your coinsurance. Before the call ends, the hospital portal refreshes with a payment request. The explanation of benefits is not a bill, but the processed claim has already appeared somewhere else as money the hospital expects you to pay. You open the emergency savings app and stare at the available balance. For years, you have told yourself that this account is for emergencies. The portal says this qualifies. You type 2,000, you pause. Then you press confirm. You do it before you have fully decided whether the amount feels fair, because the portal has already started treating it as money due. The confirmation appears. Your savings balance drops. You have made a payment without making the problem disappear. 2 numbers now belong to 2 different stories. The first says the protection worked. The second says the protection has reached your front door and is asking for cash. This sequence is fictional. The hospital visit, the employer-sponsored individual plan, the $24,700, and the $6,000 are narrative figures. Real claims vary by service, plan, network, allowed amount, and the way a plan counts spending. A large patient responsibility amount does not automatically mean a claim is wrong. And covered does not mean the insurer pays every dollar. But the feeling at the kitchen table is real. You paid for insurance, you followed the network rule, you went through the official process. Now you feel as if you have been charged twice. 3 weeks earlier, that feeling would have been hard to explain. You packed a bag, drove to the hospital, and handed the front desk your insurance card. The registrar typed in your member ID and said, "You're in network, this is covered." Those words got you through the doors and into a bed. At discharge, a billing clerk smiled and said someone would send information about any remaining costs. You assumed remaining would mean a small amount or nothing. You walked out with a follow-up appointment and a sense that the system had handled everything. The only paper you carried out was a discharge summary. The only number on it was your next appointment date. Then the EOB arrived. Covered turned out to be the beginning of a question, not the end of one. So one question remains in the room. What was the premium for? You scroll back through your pay stubs and find the insurance premium sitting quietly among taxes, retirement contributions, and other deductions. It has left every 2 weeks since you started this job. No drama, no separate decision. Just a schedule you barely noticed. You treated it as the price of being responsible. You never expected that line to become the background for a $6,000 responsibility. The premium bought something narrower than the care itself. It kept the policy active and gave you access to the plan's coverage rules. It did not prepay every covered service. The allowed amount is what the plan recognizes for a covered service. The deductible assigns an initial layer of covered spending to you. Coinsurance is the percentage you may owe after the deductible. These are different rules answering different questions. None of them is visible from the insurance card in your wallet. This is the first collision. The money paid in advance feels invisible. The money required now is impossible to ignore. One amount left on a schedule you barely noticed. The other arrived with a deadline you will remember. The premium runs on a payroll clock. The deductible runs on a plan year clock. The hospital portal runs on a billing clock. Your checking account runs on a weekly clock. The insurance card makes them look like one system. At the kitchen table, they become several deadlines competing for the same cash. You open the plan portal and find the deductible meter. It is at 0 for the year. This plan uses copays for office visits and prescriptions, and the hospital claim is the first expense large enough to touch the deductible. The bar is a clean, straight line waiting to be filled. The hospital claim pushes it forward. It does not erase the amount assigned to you. You watch the bar move. A small animation fills a fraction of the line. In a benefits document, that animation would look like progress. Here, it looks like the beginning of a year-long financial obligation you did not choose. A deductible is not a moral judgment. It is a threshold in a contract. The problem is that a threshold can look manageable in a benefits document and feel destabilizing inside a household. KFF reported that in 2025, 34% of covered workers were in plans with a general annual deductible of at least $2,000 for single coverage. That figure does not describe every worker or every insurance arrangement. It does show why the word insured tells you less about immediate cash exposure than many people assume. Two employees can both say they have health insurance while facing very different cash demands. One plan may pair a lower deductible with a higher premium. Another may carry a higher deductible and a smaller payroll deduction. The cards can look almost identical in a wallet. The cash gate behind them can be very different. You scroll back to the EOB and find the coinsurance line. The deductible did not end your responsibility. Under this fictional plan, the remaining deductible was applied first. After that, the remaining allowed amount was shared. The plan paid a percentage. You owed another percentage. Exact percentages vary by plan. Reaching the deductible does not bring the bill to zero. That is why covered is such a comforting and incomplete word. Covered means the service falls under the plan's rules. It does not mean you owe nothing. It does not mean the deductible has been met. It means you entered through the correct door. It does not tell you how much cash is required on the other side. You read the EOB a fourth time, line by line. Somewhere between the service date and the remark codes, the document gives you what you asked for. A complete explanation of why you owe $6,000. The explanation is accurate. It does not make the missing $2,000 in your savings account feel any better. You look at the two columns one more time. Plan paid. Your responsibility. The document is behaving exactly as it was designed to behave. It is telling you the truth in the only language the plan has. The language of who owes what. You save the PDF and close the browser. For a moment, the problem is out of sight. Then the hospital statement arrives in the mail. Same service date. Same claim number. The same amount, presented again as if it were new. This is when the shape of the event changes. The EOB, the hospital statement, and the payment portal arrive on different days, through different channels with different buttons. One medical event acquires several financial faces. Each face makes the same amount feel fresh. By the third time you see the number, you are not deciding whether the claim is correct. You are deciding which account will absorb it. You mention it to your partner that evening. I thought insurance covered it, your partner says, holding the EOB. The hospital was a network, you say. The service was covered. The claim was processed correctly. Then why? Your partner stops and reads the bottom line again. Almost $25,000 paid. That's good, right? It is good. It is also $6,000. Your partner puts the EOB down. We should have read the plan more carefully, they say. We did read the plan, you say, but you know that reading a plan and understanding what it would mean for a real hospital bill are two different things. The benefits summary did not have a line that said, "This is how much dinner out you will lose." The document carries two truths at once. Insurance reduced the amount left to the household and paid a substantial share of the recognized cost. The portion assigned to you is still large enough to change the month. Why didn't the premium cover it? Your partner asks. You nearly repeat the question. It sounds reasonable when spoken aloud. The premium was taken every month. The hospital was in network. The care was covered. The plan paid $24,700. And now the household is deciding whether to delay a home repair, reduce a savings transfer, or move money between accounts. Institutional language has become a relationship conversation. No one at the counter is failing a character test. A complicated financial system has handed one document to the household and asked one person to explain what it means. You open the plan summary and check the out-of-pocket limit. It sounds like the number that should end the danger. For covered in-network services, that limit generally places a ceiling on certain cost sharing during the plan year. But it does not mean every medical dollar counts toward that ceiling. Premiums are generally excluded. So are balance billed amounts, non-covered care, and some out-of-network expenses. The details depend on the plan. Federal protections apply in specified emergency and certain out-of-network situations. Other contexts can differ. Nothing about this fictional claim establishes a legal violation or a billing error. Here is what the EOB does not emphasize. Your responsibility did not start at $6,000. Before the out-of-pocket limit applied, the remaining deductible plus your coinsurance share came to $6,940. The limit brought the number down to $6,000. The card protected you from $940 more. It still left you with a number large enough to change the family's month. If an out-of-pocket limit sits higher than $6,000, a $6,000 patient responsibility can fit inside the plan's rules and still be a household crisis. Protection from a much larger covered expense does not create the cash needed today. Can they take the savings account? Your partner asks. The account is not automatically part of the claim, you tell them. But the question has already changed something. It turned an insurance document into a threat to the family's reserve. You both stare at the savings balance for a moment. Then your partner says quietly, "If we could just not think about it for one night. Can we still do dinner out this week?" You do not answer immediately. The question is not really about dinner. It is about whether the family's ordinary life is still available after the transfer. The installment reduced the hospital balance. It also reduced the margin around every other decision. You open the savings screen again. The number is lower. You calculate how long it might take to rebuild the account if nothing else goes wrong. Then you remember that something else is always possible. Over the next few weeks, the calculus shows up in small places. You unsubscribe from a streaming service without telling anyone. The grocery list gets shorter. Your partner asks whether the car can wait another season before its maintenance. None of these decisions is catastrophic in isolation. That is precisely the point. A $6,000 responsibility does not need to ruin a household to change it. It just needs to arrive. This is the insured cash gate. That is a quiet ledger phrase, not an insurance term. It describes a specific tension. Insurance can protect you from the ceiling of a covered event while still requiring enough immediate cash to destabilize the household. A ceiling protects you from the top of the loss. A cash gate determines what you must supply along the way. When people say insurance protected them, they may be describing the ceiling. When they say the bill still damaged them, they may be describing the gate. Both statements can be true about the same medical event. This is where cost sharing becomes wealth psychology. Not because you are making an investment decision, but because cash represents time, options, and the ability to absorb uncertainty. $6,000 is not only a number owed, it is a subtraction from the number of futures your current reserves can support. The Federal Reserve reported that 91% of adults had health insurance in 2025. Widespread coverage is not the same as widespread liquidity. The same report found that cost-related skipped medical care was strongly connected to family income, while unexpected expenses remained common. Those findings show that coverage and cash security are different measurements. A person can be insured and still have to decide which account will absorb the first shock. The claim refuses to stay in one place. The EOB waits in your email. The hospital statement sits on the counter. The portal holds the payment button. Your bank app records the transfer. Your pay stub keeps showing the premium. The deductible meter lives behind another login. You have to assemble the full story yourself. Each screen shows one piece. None of them was built to explain the household impact created by all the pieces together. That is why the phrase "insurance paid" can be emotionally misleading. It is meaningful but incomplete. The insurer paid. The patient still owes. The mind wants the first fact to cancel the second. It rarely does. The next week, another statement arrives. For a moment, you think the balance has increased. Then you compare the service date and claim number. It is not a new medical event. It is another presentation of the same event on a different schedule. The EOB explains how the insurer processed the claim, the provider's statement and portal request payment. Those documents have different roles, even when they contain matching dates and amounts. One event has acquired several financial faces. You find yourself reading every line, looking for a code that might explain the same number away. There is no new information. The statement simply repeats what the EOB already told you. But the repetition is the message. This number will keep appearing until it is paid. The CFPB reported that, as of a June 2023 snapshot, about 15 million Americans had more than $49 billion in medical bills and collections on their credit reports. That is dated context. It is not a current measure of all medical debt, and it is not a prediction about this fictional claim. Credit reporting rules and court decisions have changed since that snapshot, but this story does not need to reach collections before it becomes serious. The pressure begins earlier when a payment portal changes the meaning of an emergency savings account. By late fall, the plan dashboard still shows the deductible met and the in-network out-of-pocket maximum reached. You assume the next covered in-network expense may require little or no additional cost sharing under this fictional plan. The exact treatment still depends on the service and plan terms, but that relief has a date attached to it. December passes. On a gray January morning, you pour coffee and open the plan dashboard. The colorful summary screen loads. There it is, the same word you have been avoiding: deductible. The meter has reset for the new plan year. The bar is clean again. It does not care that your savings account is still recovering. It does not know that you reorganized the budget to make the second payment. It simply starts counting again, at 0, under the new plan year's terms. You check the hospital portal one more time. The remaining balance is still there, smaller than before, but the payment plan you set up is still running. 2 different calendars are pushing you in 2 different directions. One counts down what you owe. The other counts up what the plan may ask you to absorb next. The hospital claim is behind you. The $2,000 payment is still gone. The premium deduction continues. The insurance may still be valuable, but the threshold has started again. Your savings account remembers the transfer. The plan's accumulator does not remember it in the same way. The plan year resets. Household liquidity does not refill with it. Protection and liquidity move on different clocks. The insurance card did reduce your exposure. Without the plan's negotiated rates and payment share, the recognized cost to the household could have been much larger. That protection matters, but it was aimed at limiting the ceiling. It did not guarantee that the remaining amount would fit inside your checking account. You close the hospital portal, the $2,000 payment is recorded. The remaining balance is smaller. In another tab, the new plan year dashboard is still visible. Your insurance card returns to your wallet. It has not failed to be what it is. It was simply never a promise that medical risk would leave your life without passing through cash. Premiums left your paychecks all year. The deductible waited for a covered event. Coinsurance followed. The portal converted the processed claim into a deadline. Emergency savings supplied the first installment. Then January began a new accumulation period, before the old financial disturbance had fully disappeared. The household did not move from safe to unsafe in one dramatic moment. It moved through a series of small, official, understandable steps. That is why the final EOB line feels so disorienting. It compresses the whole sequence into one number labeled "Your Responsibility." That number belongs to you in the plan's accounting system. It also enters a larger system of time, relationships, reserves, and choices. It competes with every other purpose for the dollars you have left. The insurance card may have capped the damage. It did not decide which future expense the household would postpone. So when an EOB places an insurer-paid amount beside a patient responsibility amount, both facts can remain true. The plan paid a substantial share, and the remaining share is still financially heavy. The care was covered and the payment is still real. The amount may be valid under the fictional plan, and the checking account may still experience it as a crisis. The protection matters even when the cash gate is difficult to cross. The card did protect you from the whole bill. It just never promised that the part left for you would fit inside your checking account.